Hey everybody, Tortoise Investing. Today we're going to be taking a look at 3 stocks that you can buy and hold forever. These 3 are dividend payers and are down big time year to date. Now, today was another positive day in the market. S&P up over 1%, NASDAQ up over 1%, and the Dow Jones up 0.4%. Before we dive into these, if you're new, hit that subscribe button, drop a like down below. It makes the YouTube algorithm happy, and I would greatly appreciate it. None of this financial advice. Always do your own research before buying. Now, CVS, SBUX Corporation, and MSCI are the 3 we are going to be taking a look at today. Starting off with CVS, they're down 30.77% year to date. Now that might look very scary and terrifying, and I understand, but they are the biggest, when it comes to prescriptions, they hold 25% of the market when it comes to that. I think Walgreens is second place with 14%, so they are the top dogs when it comes to that. Dividend yield of 4.76%, payout ratio 43%, so there's plenty of room to grow that going forward. Revenue over the last 10 years grown at a rate of 10.93%. Now this is something that they have forecasted is going to be flat or slightly up over the next couple of years. They are trying to fix some things and get some things sorted with their debt and just expand onto what they already have as a foundation. Now the free cash flow, 10.59% up over the last 10 years. As you can see here, a nice little up and to the right, but since 2021 we are trending down. EPS growth, 5.63%, so nothing rapid, a nice slow grower, but still going in the right direction. Now we take a look here at the quarterly. Their debt situation, have $13 billion in cash, $55.79 billion on their balance sheet in debt. Now that is a small red flag. Their EBITDA was 19.05%, so that's still not 3 times, but it's close. And usually whenever I'm looking at companies, I don't like them to have more than 3 times their debt, 3 times their EBITDA in debt, because if something major was to happen or if hardship was to hit the company for a quarter or two, it's going to be a little bit harder on them than it would a company that's got their financial sheet, a little bit better off. The dividend, as you can see here, from 2017 to 2021, flat, wasn't really growing any, but they've started increasing it slowly but surely. The last increase from 61 cents to 67 cents, and with that payout ratio, I do see them continuing pretty much mid-single digits when it comes to increasing that dividend going forward. Shares outstanding, this is something that they are also nibbling at. 2021, they were set at 1.33 billion total shares outstanding. Let's take a look at the quarterly. They're currently sitting at 1.27 billion. So what I am hoping that they are doing is taking advantage of this pullback. 30% drop year to date. What they need to be doing is buying back those shares, and by doing that, it's going to increase their earnings per share and make the EPS growth a little bit better, and it's going to definitely help them on their return on capital employed, which is below 10%. So I don't know what they're doing, but I really hope that they are buying back those shares, because this is the cheapest they've been for a bit. Let's take a look here at the 5-year chart. The last time they were down these lows was in 2020, and we all know what was going on then. Thought the end of the world was coming, apocalypse, all that fun jazz because of that little virus thingy. But, yeah, that is CVS. As you can see here, average estimates for their EPS, 589 going up to 688. So, nice little bit of growth from 2024 to 2025. And we take a look at the revenue. Average 369 going up to 389. That is in billions of dollars. So again, pretty nice growth going on there. Next up, Starbucks. I love this company. I am a huge fan of them. They are down 22% year to date, and their CEO didn't do them any good. He did not make the situation better whatsoever with that Jim Cramer interview that happened. Just free cash flow, 4.4%, dividend yield 3%, 3.12%, and the payout ratio 61.7%. A little high, but nothing to worry about there. Now, revenue's been growing at a rate of 9% over the last 10 years, and from the estimates, it's looking like they're going to continue growing around 8 to 9% going forward with their revenue. Now, the thing that a lot of people really didn't like is the reward members. Their 90-day active reward members dropped. Now, as you can see here from 2017, this is going up, and they had this little drop here. Less than 2 million, but it's still, like, what's going on there? The CEO did mention that he's going to try and have the reward program be more incentivized and something that people want to have and keep once they do try it. And the thing that I do love about them, the total stores, they are making stores left and right. You're going to have one of these things on every block at this point. 2016, they had 25.7 thousand stores. Now they're sitting at 39.85 thousand worldwide. They are pumping these things out left and right, and they have more intentions of opening up, especially internationally. They are going to just keep on expanding. Free cash flow, growing at a rate of 7.66% over the last 10 years. Not too bad. EPS growth. This is something that they said we may also be a little bit slower. But how do you combat that? Well, it looks like your stock's down. Same thing with CVS. Buy back those shares. Get the return on capital employed and that EPS going. Right now, if they have anything set, any dry powder on the sideline they were wondering what to do with, they should be buying back these shares because it just keeps going lower and lower. It's a great company. Everyone loves their coffee. Everyone loves caffeine. And when you think of coffee, what's the first brand that comes to your mind? Probably Starbucks. Now, the debt, they have $12.2 billion in debt. They have cash on hand of around $4 billion. But their EBITDA is $7 billion, so it's not even 2 times. So it's not really an issue there. They've had a history of having a great balance sheet. Now the dividend as of late has been increasing at a rate of around 7 to 8%, and I think going forward that's probably what you can expect out of them. Now the shares outstanding, take a look here at the quarterly. They are nibbling here and there. They are down to 1.14 billion. The Q4 of 2021, they're at 1.19 billion, so they are slowly but surely buying back shares, and I hope they're doing it very aggressively. I just can't stress that enough. Your stock's down a lot, you buy back those shares. Return on capital employed, they had the 2020 COVID dip. Everything did pretty much. 2021, things were right back into the races. 21%. 2022 was 24.5, and 2023 are setting at 29% return on capital employed. EPS 362 to 426, so some nice growth there, and revenue 36.98 billion and going up to 40.18 billion. So again, right around 9% growth from the revenue. Hopefully cash flow falls in line. You continue getting those mid to upper single digit increases on your dividend. Last one we're going to take a look at, MSCI. You got this one, you got SPGI, and you got Moody's MCO. I like MSCI a little bit more. I think that it's cheaper overall compared to those other ones. Dividend yield 1.37%, payout ratio 39%, not too bad there whatsoever. At one point, this thing cracked over 600. It's now down to 475. So if you've been looking at an opportunity to jump in, do your research because now might be your opportunity. So they have dipped into the low 400s range and upper 300s range a time or two over the past 3 years. So again, this might be a little bit of a pullback. If you're thinking about making having an entry position, now might be the time. Take a look at it. Revenue's been growing at a rate over 9% over the last 10 years. Very nice, up and to the right. We take a look here. We got retention rate. This is very reliably in the in the low 90s. So we got 94, 93, 93.6, 92.8. So staying above 90% when it comes to the retention rate, and their EPS growing at a rate of 22.84%. Nuts. Absolutely silly. You know why? Because they buy back shares, which is what your company should be doing if they have a dip. Take a look here at the quarterly so we can see the debt. Debt is at $4.37 billion. They have $519 million cash on hand. We take a look here at the EBITDA. EBITDA is $1.71 billion. So not quite 3 times. It's getting there. It's close. I would like to see these debt levels continue dropping. Let's see here. It looks like they are chopping at it slowly but surely. And yeah, the dividend. This is where they really shine. 22.5% average increase over the last 5 years. So the last one coming in right at 16%. This thing, mid-single digit dividend growth is something that you can expect out of MSCI. And I love that about this company. Now, another thing I really like about them, return on capital employed is above 30%. 30 through 32% in 2022, 34.6% in 2023. So not only do they have 3 times what the average market company has, which is around 9 to 10%, it's growing, which is just awesome. So take a look here at the quarterly at the shares outstanding. Q4 2021 set at 83.58 million shares, and right now Q1 2024 we're at 79.51 million. Again, I hope that they are buying back shares, taking advantage of this dip, because they have nice amount of free cash flow, and that free cash flow is growing. So yeah, MSCI, all 3 of these really, if you were looking for healthcare stock, you got it. You're looking for a consumer, you got it. You're looking for financial tech, you got it right here. MSCI EPS average $13.59, going up to $15.62. So again, nice little bit of growth there. I think that is also double digits or right at it. And revenue, $2.83 billion, going up to $3.09 billion. So again, nice little bit of growth coming from that as well. That is everything I got for you. Hope you enjoyed that. Let me know down below if you own any of these or if you're looking to buy anything. And until next time, take care. See ya.